Welcome back to the channel, and thank you for joining me. I'm Algabot, your guide to the world of automated trading on MetaTrader 5. In today's deep dive, we're unpacking a pure price action expert advisor called the Fair Value Gap StackWindow. This strategy is built around one of the most talked about smart money concepts on trading social media, the fair value gap, also known as a three-candle imbalance. But it adds a clever twist. It only trades when several gaps stack up in the same direction. By the end of this video, you'll understand exactly how it spots, filters, and rides those gaps, and how it manages its risk. Let's get straight into it. So what exactly does the Fair Value Gap StackWindow do? At its heart, this is a pure price action system. There are no moving averages, no oscillators, and no lagging indicators of any kind. Every single decision is made from raw candle highs, lows, opens, and closes. The one concept it relies on is the fair value gap, sometimes called a three-candle imbalance. A fair value gap appears when price moves so aggressively that the middle candle leaves a clean gap between the high of the candle before it and the low of the candle after it. That gap represents a zone where the market moved too fast to trade fairly, and price often returns to it later. Now, here's the key insight that makes this strategy different. A single fair value gap is everywhere, and on its own it's mostly noise. But when an institutional move is genuinely powerful, it travels so quickly that it leaves 2, 3, or even more unfilled gaps all pointing the same way, formed within just a few bars of each other. That cluster, the stack, is the real fingerprint of strong displacement. This EA only takes a trade when such a stack exists. Once a valid stack is present, the strategy waits patiently. It wants price to pull back into the freshest gap of the stack and then react in the direction of the trend before committing. This makes it a high-conviction continuation strategy rather than a reversal gambler. It's best suited to liquid, impulsive markets and time frames. Think gold or a major index on the 5 to 15-minute charts. Although the code itself is completely timeframe agnostic and runs on whatever primary timeframe you select. If you're a trader who appreciates clear structure, patience, and clearly defined risk, this logic will feel right at home. Let's walk through the engine step by step. The EA acts only once per fully closed bar, so it never reacts to the noise of an unfinished candle. On each new closed bar, it first calculates the average candle range over a look-back window, by default, 14 bars. This average becomes its yardstick for what counts as a powerful move. Next, the strategy looks at the most recent trio of candles to detect a fresh fair value gap. It measures the body of the middle candle. If that body is at least the minimum displacement factor, by default, 1.2, times the average range, the candle qualifies as a strong displacement. For a bullish gap, the displacement candle must close higher than it opened, and the high of the first candle must sit below the low of the third candle, leaving a clean imbalance. A bearish gap is the exact mirror. Each qualifying gap is stored in a live list. The EA then prunes that list. Any gap older than the expiry bar setting is dropped for going stale, and any gap that price has closed straight through is removed too, because the imbalance has been filled and the idea is dead. If a position is already open, the EA simply waits. The stop loss and take profit manage the exit, and only one trade per magic number runs at a time. Otherwise, it checks market structure using a pure close versus close comparison. If the latest close is above the close from 20 bars ago, that's an uptrend. If it's below, that's a downtrend. Now comes the signal. For a long, the EA requires an uptrend and a valid bullish stack, at least the required number of same-direction gaps, all clustered inside the stack window. It then checks two things on the latest bar. Did price tap into the freshest gap? And did the bar close back up, holding that gap? If both are true, the EA signals a buy. The stop loss is placed just beyond the far edge of the entire gap cluster, plus a small buffer, so that a genuine fill invalidates the whole trade idea. The take profit is set at a fixed reward-to-risk multiple, by default, 2 times the measured risk. The short side follows the very same rules in reverse. Here's the heart of the MQL5 code, as you'd see it in MetaEditor. At the top are the input parameters, which you can tune in the strategy tester. Lot sets your position size. MinDisplacementFactor controls how large a candle body must be, relative to the average range, to count as real displacement. Raise it, and the EA becomes pickier about what it calls a strong move. Required stack is how many same-direction gaps must exist before a trade is even allowed. The default of 2 is what gives the strategy its name. Stack window limits how far apart. In bars, those gaps can form, keeping the cluster tight. TakeProfitRR sets the reward-to-risk multiple, and StopBufferMult adds a cushion beyond the cluster for the stop. Expiry bars decides how long a gap stays valid, while structure loopback and range loopback control the trend and average range windows. Now the signal block. The condition checks 2 things at once. Uptrend must be true, and tri-stack must confirm a valid bullish stack, handing back the freshest gap as zone L and the far edge of the cluster as stack low. Inside, tagged is true when the bar's low dips into the gap. That's C3L being less than or equal to the gap's high. React is true when the bar closes higher than it opened and closes at or above the gap's low, meaning the gap held. When both are true, the EA reads the ask price as the entry, sets the stop to the lower of the bar's low or the cluster's far edge, minus the buffer, measures the risk, and projects the take profit at that risk times the reward multiple. Finally, trade.buy fires the order. The sell side, just below this in the file, is the precise mirror of everything you see here. Let's watch the strategy trade on this illustrative gold chart. On the left, price pushes higher with 2 strong displacement candles. Each one leaves a clean fair value gap behind it. You can see them marked as the 2 green shaded zones. Because both gaps point upward and form within just a few bars of each other, they qualify as a bullish stack, which is exactly what the EA is waiting for. Notice it does not chase the move. Instead, price drifts back down and taps into the freshest green gap. That bar then closes back up, confirming the gap held. This is the trigger. The buy entry fires right there. From the entry, price resumes its climb, candle after candle, until it reaches the take profit level above, locking in the reward at the planned multiple of risk. Now watch the second half of the chart. Momentum flips. Price prints 2 strong bearish displacement candles, each leaving an unfilled gap below it. Those are the 2 red zones, a bearish stack inside a downtrend. Once again, the EA stays patient. Price rallies back up into the freshest red gap, tagging it from below. The very next bar closes back down, showing that the gap rejected price and the sellers stepped in. That's the mitigation reaction the strategy demands, and the sell entry triggers. Price then rolls over and falls toward the take profit below, completing the short. See the pattern in both trades? A stack forms. Price pulls back into the freshest gap. The bar reacts in the trend direction, and only then does the EA commit, with its stop tucked safely beyond the whole cluster. No indicator predicted these moves. The structure of the candles told the entire story. And remember, this is a clean, idealized example shown for educational purposes. Real markets are far messier and far less tidy. And that brings us to the end of our breakdown of the fair value gap stack writer. Today we covered what a fair value gap actually is, why a stack of gaps signals genuine displacement, how the EA waits for a pullback and a reaction before entering, and how it places its structure-based stop and its reward-to-risk take profit. I hope this gave you a clear and honest look at how the logic really works under the hood. Please remember that everything in this video is for educational purposes only and is not financial advice. If you found it helpful, please smash that like button, subscribe for more MetaTrader 5 strategy analyses, and drop a comment with the strategy you'd like me to break down next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.